I'm Alan Kinney, Editorial Director with REIT.com, and we're at the Wynn Las Vegas for REITWorld 2015, NAREIT's annual convention for all things REIT. I'm joined by Phil Hawkins, CEO of DCT Industrial Trust. Phil, tell me, what do you think about the balance of supply and demand right now in the industrial sector?
I feel excellent. I'm very bullish on our business. Supply is showing a lot of discipline. I mean, developers are funded primarily by institutional equity, very knowledgeable about the business, very knowledgeable with the markets, so making, I think, well-informed, disciplined start decisions and leasing decisions. And the demand has never been better. Certainly driven by e-commerce, but really across the board, you know, distribution tenants are growing. They're making decisions quickly. Vacancies levels are low in the markets. Rents are growing. It's a good time right now to be in our business. And it has been for a while, and I think it will continue for some time.
And when we spoke in the summer, you said the time was right for DCT to be doing some development. Anything changed since then?
It's been an outstanding time to be a developer. We have, since that time, we had a portfolio that was 7% leased, a development pipeline. Since then, we've grown the portfolio by an additional $300 million of starts. It's now $565 million, and it's 91% leased. Reflecting the demand I just spoke about. It's been a very healthy demand, very decisive tenant decision making. It's been an outstanding time to be in the business.
But then, of course, there's also the paying for it side of that. Have any developments in the capital markets made development maybe any less appealing going forward? Because
development is so predominantly funded by equity and low leverage developers, like us, like other public REITs, even private developers are funded by equity mostly. I don't think interest rates will have a big impact on costs. To me, the question is, will interest rates, and rising interest rates, have an impact on cap rates and therefore the margin or the profitability of development? And I think that the market is expecting a modest increase in interest rates. Cap rates relative to interest rates are pretty wide. I think buyers, despite what looks like very healthy pricing, cap rates are still low or high relative to interest rates. I think there's cushion there to be absorbed. I don't think that interest rates will be a big factor in terms of development decisions and development profitability. I think what's more important is if interest rates are going up because the economy is looking better, that hopefully bodes well for demand. And if demand is strong, rental rates will remain healthy and hopefully growing, which will, I think, add to or continue an environment where development is a profitable business for those companies that have the capability.
So then do you think that development will continue to grow in 2016?
For the industry, I can't speak. I suspect that development levels will be similar to that they were in 15, perhaps a little lower. In our company's case, because 15 starts were so strong, driven by really beyond expectation leasing, that it's hard for us at this early stage to set expectations that would be higher than 15 levels. Hope for that. If the markets and leasing continue, it's certainly possible, but I'm much more focused on asset by asset, project by project, underwriting consideration. And I think that leads likely to expectations going into 16, where our development pipeline and level of starts will likely be less, not more.
Thank you so much for your time.
Thanks for having me.
Be sure to visit REIT.com for more from REITWorld 2015.